Daily Fiscal Pulse for the 26th of August, 2026. Our standard one-day look-back format. Here's how the money moved through Wednesday's market close. Before we dig into the numbers, let's acknowledge what's capturing attention out there. Equities and market momentum are the headline story. We're seeing Salesforce jump 22% for its second best day on record, and that software rally is clearly shaping how traders are positioned and what they are bidding on. Against that backdrop, let's see what the fiscal flows actually tell us. The flow picture shows net transfers landed at $33.5 billion. That's not alarming on its surface. What matters more is the trajectory. Look at the 5-day average and it's running at roughly half the pace we saw not long ago. The real driver here is household transfers, which accounted for $32.3 billion of that total. The ES chart reinforces that message. Futures settled at 7,692, sitting notably beneath the 20-day moving average of 7,710. Over a 20-day window, we're looking at a 440-point trading range, and it's drifting lower. Both the flow data and price action are pointing in the same direction. Zooming out, the deceleration becomes unmistakable. Government spending on a 5-day basis is averaging roughly $3.6 billion per day. Stack that against the 20-day average of $15.1 billion and you see the pullback clearly. What this means in practical terms is less cash entering the system, fewer dollars flowing through households and into equities. The result is tighter financial conditions. Looking year over year, the story stays consistent. Fiscal spending from the start of the year is running at $1,617.9 billion, down about 3% from the same stretch last year. That's a material reduction in the amount of fiscal support available to markets. For anyone tracking the long side, fiscal dynamics are worth keeping in focus. The fiscal environment isn't exactly providing tailwind. Our conditions gauge sits at -71. However, the historical record offers perspective. We've navigated similar conditions before, and despite lighter liquidity flows, the S&P has averaged around plus 1.6% over the following month. Price doesn't move in lockstep with liquidity. Markets grind higher all the time despite headwinds. Positioning adds nuance. Leveraged funds keep layering on long bets while margin debt is sitting in the 96th percentile. That's elevated territory. History suggests levels that high function more as a caution than a bullish signal. This is where the pieces connect. Because fiscal flows are running below last year's pace, the buffer in the system is thinner. On days when headlines are positive, equities can still work higher, but when a risk event surfaces, particularly around equities or market moves, selling can accelerate because there's simply less liquidity underneath to cushion the drop. We're also tracking 2 straight days of growing fiscal transfers. Our research shows that pattern has historically preceded near-term strength in ES. It's not predictive, but it's a dynamic we monitor. 2 items to watch ahead. Month-end settlement arrives on the 31st of August, and that window can shuffle short-term flow patterns. The next significant Treasury coupon interest payment window is around the 15th of August. Fiscal headwinds are clearly evident in today's numbers. That said, the pace of tightening may be starting to find a floor. What happens next really hinges on how these upcoming scheduled flows actually land. That's our current position.